Hi, I'm Mitch Shaw. I'm CEO of Noble Investment Group. We are a specialist investment manager in the hospitality and travel space. Well, let's talk about it from a demand standpoint. Current demand in terms of what's happening, and then more a secular shift relative to demographics. And I'll start with current demand. It makes more sense to people as they think about it on a personal level that leisure demand never really waned. If we look at the data that took place over the course of the pandemic, leisure travel remained very, very strong. People were driving to destinations, they were traveling with their families, even as cities were shutting down. Business travel acted very differently. Smaller businesses and medium-sized businesses came back a lot sooner. And so when we look at markets, and not every market is the same. So New York is clearly different than Denver, is clearly different than Nashville or San Diego or Austin or Tampa, Florida. So all of these markets have different components of what makes up their leisure demand and their business demand. But smaller and medium-sized businesses, those markets that have a lot of that, you saw business demand come back a lot sooner than you did in larger, more urban cities that rely on large businesses. That said, if you look at performance against 2019 benchmark overall US, January and February, we were dealing with the effects of Omicron and some continued shutdown. By the time we got to March, we were over 100% in an average daily rate, as I mentioned, to 2019. And from an occupancy standpoint, we started trending to where we were getting close to 2019. As we got to September of this year, again, macroeconomic headwinds, we're concerned about what was happening in travel. We actually topped 2019 from an occupancy standpoint within the industry, with ADR up almost 16%. So in today's environment, forget about if we're talking about hotels or cold storage or industrial, you want to be able to think about asset classes that have incredible demand growth and very low supply growth, that have these secular themes around them, and that can price daily or price a lot quicker than 10-year retail leases or 20-year office leases. Think about it in terms of just what we have gone through. And you had the historical long-term average supply growth has been 2%, roughly. And that's going back, multiple decades here. And as we got to 2019 and 2020, the amount of starts. So there was a couple of things that were happening. Prior to the pandemic, you saw that it was harder and harder to build these hotels in markets that you wanted to build. Why? Because multifamily developers were taking sites, mixed-use developers were taking sites. Just the affordability of where you wanted to be was very, very difficult. That was number one. Number two, the cost of construction was very, very high. And so even though financing capital was readily available, those things made it a lot more difficult. Now you get into 2020, and you've got COVID that's taking place. You've got supply chains that have been shut down. And so there weren't a lot of starts that were taking place during that time. Now you fast forward into 2021, you got further supply chain disruptions, and you've got unemployment that is at low levels. You can't find people in which to do a lot of these construction projects, et cetera. So you've got multiple years now where you've not had new supply that is entered into the system, costs and inflation going up, so material costs are super high. And now today you've got financing market that has dried up in most cases for new development, and the cost of financing has gone up. So all of those things put together are creating a moment in time whereby the long-term demand prospects are very, very strong. and the long-term supply constructs are very low. I would guess for most people that have stayed in these hotels of late, it's an easy one to understand just based on their own customer experience. These hotels, which originally started to just become the lower cost, more efficient versions of their full service Marriott and Hilton kind of families, have now evolved significantly. The When you walk in, there is a naturalized scent, kind of like when you walk into a retail store, right? There's a sense of place. There is there is food and beverage offerings that fit what you're looking for. You're not looking for 3 meals a day because you want to be in an environment where you can go and next door to a great local restaurant and this. But if you want to have, a cup of coffee, or if you want to have a beverage with a friend, there's great areas for all of those to be. There's great health and fitness and wellness that's incorporated a part of it. The room itself, between the mattresses and the showers and the 50 screen inch TV that you can stream, your favorite shows on, all of that is the new model of room. But I'll take it one step further. Recognizing that a lot of people that are looking for alternative lodging, the goal is that they're looking for places where 3, 4, 5 people can go together and have a communal area. So now these hotels, we've created these communal rooms where you've got this one great room that's got a kitchen and a dining table and a living area, and you've got 4 or 5 lock-off rooms where people can have their own room but yet congregate and be together. So you've got the amenities that you're looking for. You've got the health and wellness that you're looking for. You've got the room that you're looking for, and it's new, right? So let's start there. And it's safe and clean, and all of these, kind of meet the consumer of today and tomorrow, and the largest swath of traveling public. And oh, by the way, we can run these with a full-time employee equivalent that is a fraction of the full service hotels. Why? Because we don't have 3 meal a day restaurants. We don't have large banquet and catering operations. And we don't have all this space that you've got to have, repair and maintenance personnel and the like. And so that creates a very efficient, high margin business off of the revenue that's on things that people just want. And that's the evolution of this business that continues to take place, which is why it's turned into a significant institutional asset class. It is, but I'd also caveat that this is a very much a operating business that requires a specialist skill set, because if you think about these businesses, they they require you to take a look at the revenue stream and be very thoughtful about revenue management, the right kinds of businesses on the right days. So I'll go back to Thursdays and Sundays being up 10%. It changes how you're structuring your day and length of stays, how you're marrying that to housekeeping. So, for example, if you have a guest and they're willing to pay you $20 more, but they only want to spend 2 nights there, versus another guest that is willing to pay you perhaps $20 less, but they're going to be there for 4 nights, and they're also going to be consistent over 2 to 3 weeks time. The profitability of that business is in many ways better for you. So you have to think about those things. You have to bring technology innovation to the table. And you've got to be able to continue to reinvest in the asset to drive performance. Having said all of that, the unleveraged returns in hotels today are higher than the leverage returns of any other asset class. So we're talking about something where, from an opportunity, you can buy at high single digit unleveraged yields. And because of what's happening on a secular basis with demand, those unleveraged high single digits can become unleveraged double-digit yields. And then as the capital markets, will flatten out a little bit and will return more to, a normative environment. For the vast majority of my career, the federal funds rate was 4.25%. So let's just level set that we're still dealing with interest rates today that are lower than what we have dealt with over time. But that said, being able to have those kinds of cash yields, distributable cash flow, is very meaningful.